Welcome back to Morning Markets on Thursday, the 8th of July. George Bell here, investment analyst, to provide an update on the key economic events and markets over the last 24 hours. Looking first at equity markets, generally a positive day. You had the UK FTSE 100 up around 0.7%. You had the US S&P 500 up around 0.34%, and in Europe up around 0.6%. The majority of the attention was focused on the bond market, as it has been throughout the week. The chart on screen demonstrates the downward move in the yield on 10-year US Treasury bonds, reflecting a second consecutive day of gains for bond holders. There have been a number of data points along the way so far this week which can point to rationalise the moves in the bond market. We had the service PMI data from the US missing expectations, causing some volatility as an example, but the index was still demonstrating expansion of the sector. But it ultimately boils down to the market sensitivity to factors which challenge the current expectations of economic growth and inflation dynamics as we move forward. I think this can be demonstrated by the following chart, which shows the shape of the yield curve and how that's changed over the week. The chart on screen shows the current yield curve in the US, which is the heavier green line, relative to the curve 1 week prior, which is the yellow line. Here we can see the longer end, which is more reflective of investors' expectations of inflation, pulling in, presenting a flatter yield curve. Yesterday, we received the minutes from the FOMC meeting in June, the Federal Open Market Committee meeting. We already knew the outcome of the meeting. As a recap, rates remained unchanged, asset purchases maintained at the current rate of $120 billion per month, but it was the change in the dot plots which caught the attention of markets, suggesting the potential for rate hikes to come through by the end of 2023, which is roughly 1 year earlier than was previously guided by the Fed in terms of the dot plot. So a more hawkish glide path than economists and investors had anticipated. But from the minutes which came out yesterday, the key takeaways were progress of the recovery has still got some way to go, but the conditions for beginning to reduce the pace or adjust the composition of asset purchases may be met earlier than anticipated following strong data readings. The Fed reiterated its intention to provide notice well in advance of any change. There was emphasis that the committee's reaction function or commitment to its monetary policy framework had not changed, despite the anticipation that rate hikes in the US will come through sooner than guided at the beginning of the year. But really, it was clear there is evidence of dispersion in views across the FOMC and in the members there as to the appropriate time and the appropriate method of reining in stimulative monetary policy measures. Whilst we did see yields move in on the day and some volatility both before and after the release of the minutes, the reaction was modest, suggesting that there was nothing too surprising that wasn't already accounted for following the press release and the publication of the dot plots from the meeting back on the 15th and 16th of June. As we move forward, the debate is clearly going on within the FOMC of the appropriate time to begin tapering the $120 billion per month asset purchase program, and that is likely to take centre stage. On the radar to look out for today, we've got the European Central Bank, who will present the results of their strategy review. Essentially, this is a large-scale review of existing monetary policy to test the current mechanisms are fit for purposes. The review includes the views of individuals from a range of backgrounds, from academics, MEPs, and regular citizens. The reason the results will be interesting is the review actually kicked off in January 2020, so several months before the brunt of the pandemic hit Europe. Since then, we're aware that there's been multiple levers of monetary policy which have been shifted by the ECB as required in response to the pandemic, moving to zero-bound interest rates, the introduction of a €1.85 billion pandemic emergency purchase programme. So a number of huge stimulative measures have been pushed through since the review initially kicked off. Climate goals will be one factor of the agenda, with the prospect of drawing in green objectivity into the criteria from the bank for the purchase of corporate bonds from the market. But the hot topic continues to be inflation, and discussions that President of the ECB, Christine Lagarde, is to adjust the current methodology, drawing in greater flexibility to the current target of 2% per annum, allowing periods of overshoot. But we'll find out more from the official publication, which comes out later today. And we look forward to bringing you up to date here tomorrow on Morning Markets. Thank you for watching.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.